Okay, so what factors determine your credit score? So the biggest one you'll see is prepayment history. This refers to your tendency to consistently make all your payments on time. It will take into account if you've missed a payment and how late that payment was. Next, we go to the utilization. This takes into account how much total credit you've been approved for and how much of that you're currently using. So if you have $1,000 credit card with a limit of $1,000 and it's at $999, the utilization is at the top end of that, and that is going to negatively affect you. We want to try and keep those balances below 50% of the limit to really boost your scores and get the maximum out of that. Next is credit history. So that accounts for 15% of the calculation determining your score. This is how long you've had credit reporting to your name. When it comes to a mortgage application, lenders are really looking to see at least 2 credit accounts on your file that have been active for a minimum of 2 years. And they like to see them either with a starting point or the limit, like for a credit card, with a minimum of $2,000. Next is new credit, and that accounts for 10% of your score calculation. So this shows your recent credit application history. Contrary to popular belief, if you're shopping for big ticket items such as a car or a mortgage, multiple credit inquiries on your file in a short amount of time will not negatively impact your score. It just will show as an inquiry. The same cannot be said for credit card shopping, however. If you're shopping around for that and multiple banks are looking and checking to see if you qualify, that will negatively affect you. Next is the credit mix. So that accounts for 10% of the calculation of the score. And lastly, this takes into account the different types of credit accounts you have reporting in your name, such as a phone bill, mortgage, car loan, credit cards, etc. In addition to lenders looking for a 2-year history on credit for your file, they also like to see a healthy credit mix. So 2 or more different sources of credit. Ideally, they would like to see one revolving credit type, which would be a line of credit or a credit card, and some kind of a fixed loan payment, like a car loan, student loan, just a personal loan, something like that. Then that shows 2 different types of payments that you're capable of making. Okay, so keeping your credit score healthy, we want to make sure all your payments are made on time every time. It shows on your credit bureau if you've missed any payments, if you've been late any times, how many times, how late you've been. So we really want to make sure that we're making those payments on time. Keep your balances well below the limit, like I had mentioned earlier. Ideally, if we can keep them below 50% of the limit, that is really going to help you keep your credit score healthy. Using different types of credit. So like I had just mentioned as well, a revolving source, which is like a credit card or a line of credit, and a fixed type loan, whether it's personal loan, car loan, student loan, etc. We want to increase the length of your credit history. So try avoiding old credit cards if possible, because that will increase the length of your credit history. And every month that your credit or credit card is added onto your credit bureau, that just builds the health of your credit score. And check your credit reports regularly. There's multiple ways you can do this through free platforms like Credit Karma. You can go straight to TransUnion or Equifax and access your credit scores that way as well. It's just healthy to keep track of, and then if something strange shows up on your credit bureau that doesn't seem right, we can handle that right away without it getting out of control.